Thanks so much for joining in today. In fact, let's talk about the first positive data point. The IIP numbers, they look quite good, positive, but it seems that the positive reading as well was a bit uneven. How did you read that particular data point?
Yeah, undoubtedly, the headline number was extremely strong. If you look at the full series, then this was the strongest number which IIP recorded since October 2012. But as you correctly pointed out, the growth is highly uneven. For instance, if you actually strip out the contribution of gems and jewelry, which is primarily related to gold, then the growth number comes down significantly. For August itself, it comes down from 6.4% to 4.8%. If you actually look at the average IIP growth for April to August, the almost 20 to 25% of growth was just contributed by this particular sector. The second important driver is, as we all know, is the auto segment, especially the passenger cars, and that was the other important bit. And in fact, if you look at IIP ex-consumer durables, the growth has actually slowed down. So if you look at the FY15 number, the IIP ex-consumer durables was at 5.2%, but that slowed down to just 3.6% during April to August. So as you very correctly said, the growth is very, very uneven, driven by few sectors, especially in consumer durables. Capital goods is also doing a little much better. But if you look at the other components, such as basic goods, intermediary goods, consumer non-durables, that remains pretty much on the moderate to weak side.
Okay. What would be your expectation for F516 IIP numbers for the whole?
Probably till November 2014, IIP is likely to stay on a stronger footing because there is a favorable base effect at play, especially in the month of August. We will also get some support as the manufacturers do some bit of inventory build-up before the festival demand kicks in. But from November 2014 onwards, we would expect the IIP to settle down probably in the range of around, closer to 4%. And therefore, for the year as a whole, we are looking for IIP growth just, averaging at, 4%.
All right, Anubhuti, then let's talk about the other data point that came out yesterday, the CPI numbers. So those are more or less in line with what the street was estimating. We got a bit of a bonus with the RBI governor going ahead and cutting it by 50 basis points. I think you as well were factoring in a 25 basis points cut. How does this change things? What's your sense in terms of the CPI data?
On CPI front, there were no significant surprises. The headline number was pretty much in line with expectation as well as the market expectation. Yes, there was some bit of surprises as far as the internals were concerned. So yes, food inflation was marginally higher than what we were looking at, but that got more or less compensated by slower core inflation. So net-net, no surprises, and that leaves our overall view for rest of the year pretty much unchanged. And that effectively means that we do not expect any changes from RBI either in 2015 or in 2016 as far as repo rate is concerned.
Oh, so no rate cut all the way till the end of next year, 2016?
Yeah.
Okay, so that's a bit of a dampener. But so let me come back to the growth picture. You spoke about how IIP this month, or in the month of August, was aided by the gems and jewelry, i.e. the gold segment. What about capital goods? That also contributed close to about 22%. That we know is volatile. How would you read the data X of capital goods and the capital goods spurt that we saw? Is it sustainable?
Now, if you actually look at the the capital good segment, that has been growing for past 9 months in succession, barring just one particular month where it contracted. So there has been some improvement, no doubt about it, but it is not as stellar as if you look at the growth in the consumer durables. So for instance, if you just focus at the average capital goods performance for April to August, it is somewhere closer to, if I remember correctly, somewhere closer to 5.5%, which has come on the back of 3.6% growth for the same period in the previous year. So there is some improvement which ties in pretty much well in line with what we are seeing on import demand for capital goods. It also ties in pretty much in line with what the investment data which CMI publishes, and that has shown an improvement in investment since June 2014. So that the capital goods story ties in very well with the investment data as well as the imports of capital good. And we do expect this recovery to continue. But yes, the kind of 20% kind of a growth is unlikely to be repeated month after month, because that was buoyed by a very, very favorable base effect. So it will remain erratic, but net-net, there is an improvement in capital goods production.
Okay, Anubhuti, then one last question before we let you go. I want to know about pulses. Is it a big concern? Monsoons haven't been great. The government has been doing its part because they've been importing a fair bit. What's your take on that front? Could it come back to haunt us maybe in the next reading or so?
Yes, that is one area of concern as far as food inflation is concerned. In fact, if you look at our headline CPI forecast for next quarter and the March ending quarter, we expect CPI to move higher towards 5% by December end, and then 5.5% by end of FY16. And besides the favorable base effect fading away as the positives from cut in retail fuel prices goes out, the other important component will be the food inflation. Till now, elevated price pressures in commodities like pulses was masked by a very favorable base effect. That has, I agree, that has gone away in the month of September. But probably with the mismatch in supply and demand domestically, with global pulse prices up by 40%, that can remain a concern going forward. And one of the most important reasons why we will see overall CPI moving higher in the months to come ahead.
All right, Anubhuti, thanks so much for joining in and giving us your take on both those two important macro data points. But time to slip into a short break. On the other side, we'll get you some trading strategies. We have Amit Harshikar as well as Chandan Tuparia. Both of them join us on the other side of the short break.